Hello, everybody, and welcome to our 2022 halftime report. My name is Trevor Wild. I'm the CEO and managing partner of Wild Wealth Management Group, and I'm pleased to present our halftime report today. Many of you have watched this or been in live presentations of our halftime report. This is one of two events that we've been doing for over 15 years. The other event that we call our forecast event, we usually do at the beginning of the year. This halftime report is something we do in the middle part of the year as a reflection of the first half of the general financial markets. I'm pleased to be presenting today, and I hope you'll find this information to be useful as you go throughout your day. I also hope each of you have had a great summer as we turn the corner into the fall, waiting for cooler weather here in Arizona especially, kids going back to school. It's a busy time for all. And thank you for joining me. What I thought we'd do before we get into the meat and potatoes of today's event is just go through our staff. Many of you know many of these people I'm about to show you, but we thought it'd be nice just to reintroduce some of them to you and hopefully put a name with a face. The last 2.5 years with COVID and work from home and all the different things that we've all been dealing with, life is just a little bit different. It feels like it's getting back to normal, but we wanted to put a face with some names. So the leadership team here at Wild Wealth Management Group, myself, again, Trevor Wild, CEO. Jackie Yoder is our Chief Operating Officer, been with us. We hired her right at the beginning of COVID. Believe it or not, I think she hired right at the beginning of April of 2020. Just done a phenomenal event managing through a really difficult and challenging time. Janine Lackey, our CCO, our Chief Compliance Officer, has been a partner of the firm now for more than 14 years and a good friend of mine and just an amazing person and part of our leadership team. You might not know all these folks. I'm not going to go through each one of them by name, but our group has grown over the years. Most of you will probably recognize one or two different names on this board here, but these are our advisors that work out of our Scottsdale office. You'll know those by name, but at least you'll have an opportunity to put a name with a face if there's somebody you talk to that you haven't met before. Our extended team, we do have offices in Glendale. We have an office in Payson, Tucson, Tempe, San Luis Obispo. These are the advisors that work out of each of those offices. And again, I'm sure most of you are familiar with at least one or two of those faces. I did want to take a second just to say thank you to our advisors. This group of professionals that have joined our organization and been a part of it for so many years are truly a phenomenal group of professionals. And I wanted to brag on them for just a second. We recently attended a recognition event back in May that was hosted by Cetera Advisors, our broker-dealer, and about 80% of our advisors have been noticed or awarded some type of award of excellence in investment management and financial planning. And I'm really proud of this group of people and professionals that have really worked through some pretty challenging periods, not only this year in such a roller coaster of a year, but especially over the last 2.5 years as we've worked through COVID and helping you and each and all of our clients through a lot of different and unique situations that I don't think many of us thought that we ever would have had to deal with, but we have in this environment. I also want to say thank you to our support team. Many of you probably spend more time on the phone with one of these folks than you do with your primary advisor, and they are absolutely phenomenal. Their dedication to helping our organization support you and all of our clients, again, especially in the last 2.5 years, has just been phenomenal. And just like you, so many different unique things that our families are dealing with, and I want to say a special thank you to our support team. They've been phenomenal, and I really appreciate them. And the rest of our administrative team, many of you know who some of these folks on the screen, so I'm not going to go through each of them one by one, but we just want to give an opportunity to put a face with a name if you haven't had a chance to meet one of the financial professionals. I know the print here is really small, but I have to say one of the things I'm most proud of here at Wild Wealth Management Group is the impact that we've had on our community. It's been about 5 or 6 years that we decided to build a community outreach program within Wild Wealth Management Group. We call that Wild for Arizona as our community outreach program, and I can tell you over the last 5 years, the impact that we've had in the general public and in our communities and with those of need has been phenomenal. On the left side of the screen here, at least as I'm looking at it, I don't want to brag, but it's also, I'm very proud of the fact that we've been recognized by some pretty amazing resources, Barron's, Forbes, We've been recognized for 14 years in a row as part of one of Barron's top 1,200 advisors in the country. Most recent, earlier this year, we were ranked number 2 in the state. Forbes also ranked us number 2 in the state. That was the second year that we were recognized by Forbes in their Best in Advisors. But again, some of the recognition that maybe isn't as specific to the industry, but I think I'm more proud of, are some of the other ones that you'll see here on the screen. Arizona Business Journal picked us as one of the best places to work in Phoenix last year, and the Arizona Business Magazine chose us as one of the most admired companies for 2 years in a row. Really proud of that. We work really hard to support our employees and to invest in our employees, and I think that recognition means more to me than the other two things on the screen. I'm also happy to say we've launched a new division. April 1st, we've launched a property and casualty insurance division. Taylor Watcott is the president of that organization within our walls. And primarily we designed and decided to do that to provide more white glove service to you as our clients as it pertains to your home, your automobile, and those insurance products that we all need. And what we have found over time, in my professional experience in particular, is that most people, your home and auto insurance just is there. And usually the discussion and focus is on price. And while price is important, if you don't have the proper coverage, it's not worth its weight and needs to be discovered. So you'll see more coming with our Wild Wild Insurance division. We're looking forward to educating you more about what we plan to do there in that white glove service. We also have a couple new employees that I just wanted to highlight here. We hired Anthony Calhoun as one of our advisors, joined us earlier this year. Kelly Hall, Kennedy Mulder, and as I just mentioned, Taylor Watcott joined us earlier this spring, leading our insurance division. On the right side of your screen, you're going to find some of the impacts that we've had in our community in 2022. As I mentioned before, this is probably one of the things I'm most proud of that we've been able to do. We've had so many clients and employees that have participated in this community outreach, and we've just had such a major impact. I'm really proud of it. Again, I'm not going to go through each one of them, but we wanted to make it a point to show you some of the impact that we've had this year and where those focuses are going. I also want to take a quick second, and if you haven't looked, drive you to our website. Our website is wildwealth.com, and if you'll go to our events page, this is where we post upcoming events. And I just wanted to take a second to highlight a few of the upcoming events that are going to be occurring. We have our third quarter charitable cause chosen, and if you'll go to the events page, you can click on that information and you can find out how you can help support that. But we also have three more events that we have scheduled between now and the end of the year that I wanted to bring your attention to. September 28th, our webinar on long-term care insurance will be hosted by Jason File. Managing Your Lifestyle will be our webinar October 26th, hosted by Jeff Anthony. And in November, Understanding Life Insurance will be hosted by Taylor Watcott. Those are the three upcoming webinars that we have. And if you didn't know, we host an educational forum that we call Webinar Wednesdays, that every month we change the topic and one of our advisors or specialists talks on a different topic. So if you're unfamiliar with that, again, I would urge you to check our website under the events tabs and you'll find more information about those upcoming events. I also wanted to say thank you to some of our affiliates. We have a handful of affiliated advisors that have offices outside of Wild Wealth Management Group. And these are near and dear partners and friends of mine, and just wanted to say hello to them and, again, allow you to put a name with a face. Many of you know this because most of our clients have been with us for 15 or 20 years, but one of the things that we've worked really hard to do to make our practice a little bit different is bring in affiliated business partners that focus on areas that we don't do. As you probably know, the advisor that you work with, his primary or her primary focus is in financial planning and investment management. We talk about insurance and all sorts of things that impact you, but we've brought partners under our roof that specialize in certain areas such as tax planning, college planning. We have real estate and mortgage planning, estate planning, health insurance, and most recently we've added the Wild Wealth Insurance Division, which will focus on property, casualty, life insurance, and disability. So I wanted to put a face to a name, and also to remind you, and if you didn't know, let you know that we do have all these services under one roof. So if there's something that you need help with, it might be a trust, or if you have a grandchild going to college and you think you need help, we wanted to point that out, that we've got professionals that focus on these different areas, and the intent here is to really provide a white glove service to help you get through or help your family work through whatever those needs might be. Well, let's get into the meat and potatoes of tonight's conversation again, but we're going to start by talking about the economy. And we can't really talk too much about the economy without talking about some of the events and the things that have occurred the last couple of years that have led us to come into 2022. There's 4 major tailwinds that we've seen really that started primarily with COVID back in 2020 that have continued to push the economy into some pretty rapid growth, especially here in the United States. There's 4 main areas that have really propelled growth as we came out of COVID in that period of time. The first was fiscal stimulus. Through the CARES Act 1, CARES Act 2, there was a total of $5.7 trillion pushed out into the economy, trillions of dollars, right? And people think, well, was this a big deal? If you look back at 2008, the last major recession, the total amount of fiscal stimulus that occurred here was dramatically more than 08 and 09, $5.7 trillion in total. On top of that, we had monetary policy, right? COVID happened, the economy seized overnight in March of 2020, and the Federal Reserve acted very, very aggressively and took interest rates down to zero basically overnight. Well, when they did that, what happens is mortgage rates go to 2.5%, car rates go to zero. All these consumer interest rates that dictate kind of what we pay when we borrow went to zero. COVID-19 cases through the tail end of 2021 started to subside and really go away. Life started to get back to normal. In fact, I was talking to a client just earlier this morning who had a cruise to Europe, and he said he was shocked at the number of travelers that were out there, but more so, he said he was shocked that there was no masks and very little precaution. So I don't know if that's good or bad. You may not like it or you might love it. But what we've seen coming into 2022 is the world was getting back to normal as COVID cases went away. The fourth area was geopolitical stability. And again, I'm not thinking about this year, thinking about the events that have occurred coming into 2022. In the last 2 or 3 years, really since before COVID, geopolitical stability has been very high. We haven't dealt with a lot of geopolitical problems, wars. These things haven't been occurring. So we had a lot of tailwinds leading into the economy coming into 2021. And the real economic growth in the United States had been strong. Last year, the U.S. GDP grew by 6.3%, a very strong year. What's interesting is coming into Q1, all of a sudden at the end of Q1, GDP growth contracted. We dropped by 1.6%. This kind of baffled people. What's going on? We're seeing economic conditions go down, and on top of that, when you look at the data points, and we've got a few of the major ones here, economic conditions really weren't pointing towards recession. The Purchasing Managers Index was above 50, which indicates growth. Job growth was strong. Unemployment rate was under 3.5%. Labor force participation rate, and consumers were spending. So it's very, very perplexing looking at the general markets and economic growth, saying, well, what's causing this? If the economy is doing so well here in the United States, why are we seeing our GDP overall down? So we wanted to break this out for you, and there's 4 major components of GDP growth that really drive growth here in the United States. The first and most important is consumer spending. Consumer spending in the United States accounts for about 70% of GDP growth here in the U.S., and what you'll see there on the screen is first quarter was very strong. Economic or consumer spending was up 1.24% year over year through the first quarter. Business spending, again, a very important impact for here in the United States, was up 0.93. Government spending was down 0.5%, which was not overly alarming. But what you'll find in that far right quadrant was net exports, right? Net exports was down 3.23%. So what you see there by looking at that is actually conditions here in the United States were very strong. We were importing. The problem was our exports dropped dramatically. We've got to figure out why. I found this quote by Diane Swonk. She's the chief economist of Grant Thornton, and it kind of tells the story. The story is fairly straightforward. Omicron wave, then the war in Ukraine and lockdowns in China took a greater toll on growth abroad than at home. So back to that slide, what happened here in the United States, economic conditions have continued to remain strong. We haven't seen lockdowns in 2022 that have forced the U.S. here locally to go back into restrictions. We've seen spikes, but economic conditions have stayed the same. We haven't had wars here, but what's happening overseas, it's a different story. And all of a sudden, all those tailwinds that we had very, very quickly became headwinds, starting with geopolitical instability. And I don't need to tell you because you watch the news every night. When Russia, which had been lining their takes up on the border of Ukraine for months, decided to push across that line in the early part of this year, the geopolitical stability that we've enjoyed for the last several years evaporated. And we're still dealing with this today. We're not going to get into a lot of detail of that, but there's a high level of geopolitical instability that is with us and will probably continue to be with us as we look down the path. On top of that, China has a zero COVID policy, and COVID started to spike again in China in the early part of the first quarter, and they went into lockdown. And lockdown in China was different than what we experienced for most parts of the United States here. 45 cities and 400 million people were not allowed to leave their homes. They're not going to the gas station. They're not grabbing snacks on the way to work. They're not buying lunch. They're not buying t-shirts. They're not shopping for new shoes. Their economy stopped. And that lasted the vast majority of the first quarter and well into the second quarter of this year, and had a dramatic impact, as you saw earlier, on our economic growth, in particular on what we were exporting out of the United States. Third, and a very important part, is fiscal stimulus. We already talked about the trillions and trillions of dollars that our government spent in making sure that COVID didn't take us into recession. Well, that's starting to patter out, and we're drying up there. And lastly, the Fed decides to tighten interest rates, as we saw earlier this year, to combat interest rates. Why? Well, because of inflation. And what we saw, and inflation has been building for some time. There's a lot of reports and stories last year talking about inflation and when is it going to come. We have supply chain constraints, all these issues that have happened. But what happened when, again, Russia rolled across the Ukrainian borders, Russia supplies 20% of the oil supply to the United States for gasoline. And we stopped buying that supply overnight. So immediately what happens is you have gasoline prices and oil prices go through the roof, and that impact is immediate. Well, what happens shortly after that is the cost of goods getting to you and I will follow right along with it. And so what we have here is inflation. The increase in average price of goods and services increased dramatically. And this is a function of not only the supply issue that we were having and demand has stayed high, but also money supply has been a big propellant of that as well. One core thing that we wanted to point out here is we've got two different columns of energy. We have PCE price index and core PCE. The government uses more of the core PCE, which excludes energy and food. The PCE price index is really what you and I and most consumers are really dealing with. We're buying gasoline, we're having to buy food, and that really tends to be the real inflationary number. We've got it listed here through May. What we did see in June and July was that inflationary number increased again in June, and it was quite dramatic. And what we have seen really since the end of June is we've seen a lot of things that have started to decline as we got through July and even into August. We'll talk a little bit more of that as we go. Well, what does that do? All of a sudden, consumers, the price and goods and everything that we pay is sky high. Gasoline goes from $3.50 a gallon to almost $5.50 a gallon in a lot of places. And what happens and how are we feeling about things? Well, the University of Michigan's Consumer Sentiment Report shows you what happened. On the far right of that screen, you can see what happened in the early part of this year. Consumer sentiment dropped to an all-time low. Came in, and it's amazing. What's amazing about what happens, and this isn't, when you go back and look at this chart and how it aligns with other periods of time, it's often that you'll find conflict or bad things occurring that causes that spike to happen. You'll notice the spike if you go back to the middle of the screen, kind of right, 2000, 2002, a dramatic fall off. Well, we had the tech bubble burst and a lot of economic fallout from that, and that's what happened. The next one over, which was 08, 09, the housing crisis, a significant drop in consumer confidence and consumer sentiment. Well, it happened again. And we're sitting at almost an all-time low. Well, what's the cause of that? All of a sudden, consumers went from feeling pretty good to feeling pretty horrible overnight. Well, you know what it is. It's what we're buying and the inflation that we're dealing with. So this screen, and this was a Gallup poll that was done back in April, that basically they polled folks and said, what's the most important financial problem facing your family today? And you'll see it right there on the left side of your screen, the cost of living and inflation as compared to the same poll that they did the last 4 years. You can see the spike. Last year only about 7% of people said they were concerned about inflation or cost of living. This year it was 32%. So all of a sudden consumers are going through this massive shift of all the media things that are going on. And it's scary. Right? I can't think of another time in history where you had a war that is scary in the potential impacts and where is it going? Is China getting involved? All those things. We've got inflation. We've got interest rates and what's going to happen to housing prices and how am I going to afford a place to live? We've got the stock market in decline, and unfortunately over the summer months now with some of these shootings that have occurred, even are we safe? Are our kids even safe in our schools? So very, very challenging mentally time for the consumer and for investors right now. And again, this inflation and the way that people feel, it impacts the way that people spend. Another really great poll, this was done by the Washington Post and the George Mason University. Through their poll, what they found today versus a year ago. 87% of people that were asked these questions today, are you making a bigger effort to find products at the cheapest price? Basically, are you shopping? Are you using coupons? 87% of people today said they were, and comparing 12% that said they were not. 74% of people today said they are delaying planned purchases because of inflationary problems, right? So not only are these things we have to deal with emotionally, but it does impact how consumers react, right? 74% of people polled said they were delayed planned purchases. 59% of people said they're saving less. 59% said they're driving less. 52% saying they're buying products in anticipation of prices going up. Now, this is a really interesting one. So 52% of people said they're buying more products today because they're worried inflation is going to go up. We wanted to dive into this a little bit more, and we found a really great quote. This situation has been termed inflationary psychology. Consumers purposefully advance their purchase in order to beat anticipated future price increases. Firms readily pass along higher costs to consumers, including the cost increase that they anticipate. Expected inflation becomes a self-fulfilling prophecy. We think we've seen some of that this year. And think about that for just a second. I'm going to go back to that slide. So consumers get worried about inflation, so they're going to start to buy stuff that maybe they don't need today. But the businesses know it, right? The manufacturers know it. So they're increasing price not only to contend with inflation today, but what they anticipate inflation to be. And consumers are so worried that they go ahead and make the purchase anyway. And again, inflation becomes a self-fulfilling prophecy. Next time you go to the grocery store, I challenge you to think about that, because I think we've seen a lot of that in a lot of different areas. All right, the last area, or the final area here, is the Fed tightening of monetary policy. This was some of those, what was tailwinds that very quickly became headwinds as we got into the year. Russia invaded Ukraine, energy and oil prices spiked, and inflation really starts to grab hold. The Fed finally made the decision to start raising interest rates. You can kind of see what's happened. We came into this year at a zero fund Fed rate, went to 25 basis points. You can see the hike. So when we were preparing these slides, that was through the end of June. Since June, in the July meeting, the Federal Reserve raised interest rates by 75 basis points. So that set the Fed fund rate at 2.5. Now, the anticipated Fed fund rate that you can see at the right side of your slide is not the gold bars, but the green one. The anticipated rate by the end of this year is somewhere between 3.25 and 3.5%. July, they raised rates 75 basis points to get us to 2.5%. But what was interesting, after the Fed made the decision, they talked a lot about the fact that what they see is positive impacts in inflation. I mean, they actually see inflation eroding, or at least inflationary, what they're doing impacting inflation. They're seeing inflation come down. We've certainly seen it in oil prices and gas prices. You know, we were at $5.50 or low fives per gallon. In Arizona, I think we're down into the high fours. We've seen gas go down by $1.50 across the country. So they opted not to have a meeting in August. The Fed decided we're not going to have a meeting in August and deferred the meeting until September. So the next Fed meeting will be in September. What's anticipated is somewhere between a 25 to 50 basis point increase in that meeting, but time will tell. We did want to show you when you go back to those late 80s, in those periods that a lot of you lived through, the fund target rate in 80 and 81 was 20%. So it kind of shows there's still a dramatic difference from what we saw in the 80s, and this is something we're going to have to continue to watch. Well, why is that important? At the end of the day, what we're concerned about is what's going to happen with the economy. And while nobody has a crystal ball, we don't know exactly where this is heading, we thought we'd line out the three scenarios that could occur. The first, and what we hope to be the scenario that we see, is what's known as a soft landing. You've probably heard that word in TV or on the radio when you're watching financial press. They've often used the word soft landing. Soft landing would be the Federal Reserve raised interest rates just enough to slow the economy. It impacts inflation to drop, but we don't see a recession. Okay. Now, the other thing that I wanted to hit on right here is a lot of people think the Federal Reserve can control inflation. The Federal Reserve can't control inflation. What they can do is they can control the cost of the cost for borrowing money. So the Federal Reserve increases or lowers interest rates. Right back in 2020, they took interest rates to zero. They did that because they were concerned that they were going to fall into a recession with COVID hitting. So they took interest rates down to zero. What did that do for consumers? Well, it took all sorts of different type of consumer related financing to very, very low interest rates. Mortgages in the 2s, car loans at 1 or 2%, all these things. And that propels, or the general idea is that incentivizes people to go out and spend money. Well, we've enjoyed that. And now what the Federal Reserve is doing is they're raising interest rates. And what that will do is raise borrowing costs, which will slow consumer spending. It's, we're going to think differently about it, right? People might not be able to buy the same value of home if interest rates are 5.5% versus 2%. So don't be shocked when we move through the back half of the year when you hear reports that economic conditions are slowing. The Federal Reserve needs to slow the economy to fight inflation. The question is, will they do too much and will jump the middle part and go to the far, well, the middle would be the worst case scenario, stagflation, where the Federal Reserve raises interest rates, we see that economic slowdown or really into a contraction, an extended recession, and inflation still continues. That would be the worst of the three. The far right recession means the economy contracts and inflation slows, but maybe more than we want. And that's what you'll hear the media talking a lot about is, will the Fed overshoot? Will they overdo it? And this is what they're talking about. What we're hoping for and what we believe is the highest probabilities that we see a soft landing. And that doesn't mean that this inflation problem isn't going to be a problem. I do think, the last decade we've seen inflation run in the 2 to 3% range. I think what we're going to have to start doing in our financial plans and as we go forward, I think that inflation is going to be at a higher rate than we've had before, but we think it's unlikely that we see interest rates that we saw, at least in the coming years, that we saw back in the 80s. Okay. So again, what does this mean? So the economy, are we in a recession? No, people are unhappy with inflation, which has recently run at its highest level since 1982, but inflation isn't recession, which is defined as a significant decline in economic activity. Economic activity is not falling. In fact, it's booming. This was a quote from Jeffrey Frankel, professor of capital formation growth at the Harvard University in June of 2013. Now, we wanted to cover this because it's never fun to go through downturns. It's not fun to see your portfolios go down. It's not fun to see the economy go through these, but we think it's important to understand that the economic cycle, it does happen. And historically, this economic cycle of expansion and peak, recession, trough, and then back into expansion has happened over and over again, just like market declines. Again, we don't like seeing markets go down. We don't like seeing our portfolios go down. But if you look back at the last 50 years of data, on average, the general market tends to go through a 20% decline on average about every 3 years. Now, part of what's happened in the last 5 years and maybe even 10 years, really since the Great Recession, is the declines that we've seen were very short term, right? COVID hit in March of 2020. We saw a 35-40% decline in the general markets, but the government reacted very quickly. A lot of stimulus, all the things that we already talked about in the markets propelled themselves to new highs, right? A few years before, we saw a slowdown that occurred at the beginning or end of 2013. Again, it was a very short slowdown. Economic conditions improved, and we've seen growth. So as investors, we've probably been spoiled with a market that's been very consistent and positive. But if you look longer term, what's normal is the market averages, again, a 20% decline about every 3 to 5 years. This is a part of the normal cycle. And just like we're showing you here, the economic cycle, where there's expansionary periods, it leads to peaks. It does lead to recessions. Now, there's a lot of different kinds of recessions, right? I think a lot of us think right back to 2008 and 2009, and that was a severe structural recession that lasted multiple years. But that's not the most common type of recession, right? Most recessions are generally short in nature and aren't as bad as we saw in 2008 and 2009. But eventually that recession period goes through a trough or a bottoming process and back to expansion. So it's important to keep in mind that while we don't have a crystal ball, we don't know exactly where things are headed, we do know that this cycle tends to repeat itself over. And whether it be the economic cycle or the fears that we have when we think about our money and our investments, these cycles repeat themselves. They don't last forever, and we believe wholeheartedly that we will see this cycle continue, just like we believe that in the portfolio we'll see things turn and we'll see recovery as we get through the next phase of this cycle. So next, we're going to talk a little bit about the financial markets and what we're seeing so far this year. And what a year it's been for the financial markets. We'll start with a little bit of humor. We found this little cartoon that looked pretty funny. While we're in a bear market, the bears may be preferred to call something else. It's not fun to be a bear right now, as this illustrates. But what have we been through? Well, to start, we've just come through the worst first half of stocks in nearly 50 years. You can see that we've got the S&P 500, the NASDAQ, and the Dow Industrial charts all on the screen. You can see what's happened. This goes all the way back to the 1970s. And you can see what kind of year it's been. The worst year start for stocks in more than 50 years. To break it down a little bit more, again, these numbers were through the end of June. You can see the Q2 returns up on the screen and the year-to-date numbers. I'm not going to go through each of these. I probably don't need to tell you because you've all had the TV on watching the news, and every day it's bust and gloom and doom, and they like to focus on the negatives, but I do want to point out a couple of interesting things that I find. Usually when we go through economic downturns or stock market downturns, the balance that we usually try to find, and what part of our job is to create balance so that when some things go down, other things go up. And we've seen this before in history, so it's not 100% unique, but I do find it important, and I think it's important for you all to understand. I'll point out the third column down is the Bloomberg U.S. Aggregate Bond Index. And the bond index, this is high grade U.S. corporate bonds, was down 10.3% through the middle part of the year. And again, you can look at the only thing that was positive for the year coming into the midpoint of the year. There was two areas. You had value, the Russell 1000, which also tended to be the worst performing asset category in the last 2 years. And you had energy. And obviously because of Russia invading Ukraine and what happened with oil prices, we saw a massive spike in oil, and that actually propped up a lot of energy prices in those stocks. We've seen a lot of that since unwind and come down. But again, I want to point your attention to bonds, because this doesn't get much media attention, and people focus on the stock market and how bad it is. But again, this is a big deal. For most of our clients being retired, there's going to be a core portion of your portfolio that's in bonds. And this, like I said before, this isn't completely unique to this environment. We've seen it happen in other declines, but it is unique and adds additional pressure to what we've seen in the stock market. And not only is the general market down, but it's been volatile. And what we looked at on this screen is the number of moves that exceed 1%, 2%, and 3%. And when you look at the first half of the year, we had 63 days, basically, where there was moves of more than 1%. 63 days in the first half of the year. Incredibly volatile market. 26 moves of more than 2%. And 7 days where the market was up or down more than 3%. Very, very volatile market. Looking at each one of the sectors a little bit, kind of through the midpoint of the year, again, there's not a lot of fun to look at on the screen, but you can kind of see some of the bright spots. Bright spots, energy being the biggest, utilities, consumer staples, healthcare. Those sectors were slightly positive, and you look at everything else, ranging from down 30% in communication services to real estate being down 8.5%. It's been an incredibly volatile market. What's interesting about this whole thing is company earnings have remained strong, right? And through that midpoint of the year, you can kind of see what's been blended for earnings growth on the year. Through Q2, what was estimated was earnings growth of 4.1%. What's estimated through the end of Q3 and Q4, another 10.5%. But basically, most of the companies in the S&P 500 are averaging or telling the expected earnings of 10.2% for the year. So it's interesting that we're having the worst year in 50 years in the stock market, yet earnings have held up relatively well. We'll have to continue to watch how this goes. And we might see some of those earnings revised lower as interest rates rise and produce another challenge for companies. On the other hand, price-earnings ratios have fallen. Now, price-earnings ratios are used to determine relative value in a company. What you can see on the graph is we had a spike at the end of last year and really into 2021, all the way through 2021, where we saw price earnings go through the roof. We've seen those price earnings ratios come down somewhere closer to historical averages. And as you can see on the screen, this time last year, the average stock in the S&P 500 was trading at about a 26.5 multiple. Today, it's trading at 19.3. That's primarily due to the fact that the general stock prices have come down, but also represents value and something that we may need to continue to watch as we go forward. This chart shows the CAPE ratio, which is another method of looking at value in companies in the S&P 500 adjusted for inflation. And as you can see, the CAPE ratio is still relatively high. We're not at the very top of that chart, as you can see, but it still shows high. But another thing that's interesting here is historically, especially the last 10 years, bond prices or bond yields have been so low that stocks offered a relatively attractive alternative. One of the things that we're seeing is we're actually starting to see fixed rate investments and the interest rate that you can get increase dramatically. Just looking at it at the end of the year, if somebody came to us and said, hey, we want to put money in a CD for 5 years, the best interest rate you could get in January was probably somewhere between 1.5% and 2%. Today, those rates have probably doubled, and we're seeing interest rates in the 3 to 4%. So one thing that will be interesting as we move forward is now that bond prices and we're seeing fixed rate investment interest rates come higher, that might take away some of the competitiveness that we saw in stocks, and we'll have to continue to watch that. The stock market has predicted 9 out of last 5 recessions. So this is a quote from Paul Samuelson, a Nobel Prize winning economist in Newsweek in 1966. The stock market downturn suggests that many investors should expect recessions. They may be right, but they may be wrong. Back in 1966, which is where this quote came from, following 2 decades of nearly uninterrupted economic growth and stock market gains, a bear market arrived. The S&P 500 dropped 24% over 8 months before a bull market began. The market downturn was unnerving, but there was no recession. That year, economist Paul Samuelson, who was the first person to win a Nobel Prize in economics, quipped the Newsweek interview, "The stock market has predicted 9 out of the last 5 recessions." Interestingly enough, about that time, the general market hit its bottom, and the markets went into a bull market that lasted for many years. Well, in 2016, CNBC decided to fact-check Paul Samuelson, and they looked at 13 bear markets that have occurred in the post-war era. During each of those downturns, stocks fell by more than 20%, stayed down for more than a month. CNBC reported that 7 of the bear markets preceded recession, so Samuelson was right. About half of the time, bear markets lead to recession. We just don't know where this one will lead yet. And while we might not know if the economy is going into recession and how the stock market might react, we do believe that the bear market for bonds is here. In this slide, you can see a chart of interest rates going back all the way back to 1960. And you can see the differential in interest rates over the years. If you look back to the far right of your calendar, you see we hit an all-time low in interest rates just about a year ago. And the driver behind bonds and interest rates in bonds is going to be inflation. And inflation is here, and the Fed has started to act and raise interest rates. Bond rates will follow, and you can kind of see that at the tail end of the right side of your screen. Well, as investors have become more and more concerned about the Fed's policy, rising interest rates, the possibility of recession, the reality of inflation, they become far less bullish and more bearish. What you can find on the slide is an investor sentiment report, and if you go back and look from May to June, you can see that just in the last 4 or 5 months or weeks of the first half of this year, bullish sentiment is eroding, meaning more and more people are feeling bearish and concerned. We recognize that it's impossible for our investors and really anybody to not be concerned. You turn on the evening news and you're talking about war and inflation and price increases, all this negative stuff. We do think it's important to remember and to recognize that these bear markets don't last forever. In fact, there's been 7 bear markets in the last 50 years. We've got them on your screen to review. And while often those downturns are very, very difficult to go through, they led to economic expansion on the other side. We think it's incredibly important at this point to make sure that your emotions are in check. If you're concerned about this, we want you to reach out to us. We want to talk about it and help you make good decisions to get through this, because we know that these bear markets won't last forever, and our goal is to make the best opportunities that we can through them.
So now that we've talked a little bit about the financial markets and where we've been so far this year, let's turn the page and talk a little bit about where we might be headed. And we can't think about this without thinking about what's going to happen with global growth, right? And what we have up here on the slide, you can kind of see what's expected for recovery and growth around the world. And we're looking at 2021, what's expected for 2022 and 2023. And take notice in the slide to the right side, you'll see Russia. And again, with everything going on with Russia, this war with Ukraine, I think you got to kind of exclude that. We know what's happening there. We know their global or their growth, their GDP is going to be significantly impacted because of what's happening. But the bottom line is what's expected is still growth, but it's not going to be the same kind of growth that we've seen in 2021 and probably not even in 2022. And we know that can't be sustained. And there are a few things that are going to lead into that we have to continue to keep our eyes on. Most notably is the war in Ukraine, right? The 3 big impacts that the war in Ukraine, we know the war in Ukraine has: food shortages. And what we put up here on the screen is you can kind of see some of the big food exports, where they come from, and the impact between Russia and Ukraine. You've probably heard of the fact that Ukraine is the breadbasket of the world. And this illustrates how important this part of the world is to the rest of the world as it pertains to the sunflower oil, wheat, barley, and maize. It's a significant impact. How will this play out? What will those food shortages be? Will we continue to see energy shortages, which cause the price of gasoline to continue to remain elevated? And it's likely that we're probably going to continue to see higher food and energy prices. But how long will the war goes, what happens? Obviously, these are something we're going to have to continue to monitor, and we believe will be an impact on what happens as we go. The World Bank basically forecasted that they believe economic growth will be declining as we get through this year, and their primary factor is the war in Ukraine. And you can read the quote up on the screen, but the war in Ukraine is leading to higher commodity prices, supply disruption, increasing food insecurity and poverty. exacerbating inflation and other financial conditions. So their view is that this war in Ukraine is going to have a significant impact and probably keep some of these prices higher than they otherwise would have been. COVID lockdowns in China. We talked about this earlier when we were talking about the current market conditions and what we've been through. Again, here in the United States, the 4 areas of GDP, this was the big one that hurt. Our exports were down almost 4%, which caused our GDP to be negative. If that would have not have been negative 4% or a normalized curve or even slightly down, GDP growth in America would look a lot different. So, and much of that was due to the COVID lockdowns that occurred in March, April, and May. So this is a big, big deal. The question is, are they going to loosen this COVID zero policy? Will COVID come back? We think this impact is a significant one and one we have to continue to keep our eyes on. And we can't go a day without hearing about interest rates and inflation on the news. But again, another big major thing that we have to continue to watch, which is, does the Federal Reserve make a mistake? Predominantly the concern here, I think, in the markets has been, do they push too far, raise interest rates too much, and throw us into a deep or a more severe recession that they didn't need to? It's interesting because as I discussed earlier, these slides and all the data points that we pulled together as of June 30th. We had a Fed meeting in July. The Fed decided to raise interest rates by 75 basis points, but opted to skip the August meeting. So they deferred the August meeting, so there was no rate increase in August, and I intend to meet the third week of September to determine if they're going to maintain their current rate at roughly 2.5% for the Fed funding rate, or if they're going to increase that. We're going to have to continue to watch this. Do they go too fast? Do they go too slow? Time will tell, but this is a big area that we think we have to continue to watch. We tried to pick a funny slide here, but investor behavior is so important, in particular in these times. We've been trying to talk to our clients about it, to you about it. But investor, we kind of relate this to a baseball game or a baseball team that might be in a slump. The team hasn't played well. They've lost 5 or 6 games in a row. All of a sudden, the players are getting down on each other. We've got hecklers in the stands. And maybe even some of these players at a point go, geez, is baseball even right for me? Do I even want to play baseball? And as an investor, these emotions are incredibly powerful. Now, it's a little bit different. We're not talking about, do we play baseball or not? But these are the questions that investors get tested with during bear markets. Should I sell? Do I stay? Or do I look for opportunities? Our belief is, and where we feel very confident coming into this year, is we believe in maintaining a well-balanced and diversified portfolio. And that means some money in cash, some money in stocks, some money in bonds, different kinds of stocks. And even in the last couple of years, we've worked in a significant amount of hedged equity positions that help buffer or reduce our downside volatility. None of those things fix the problem, right? And so that emotion that people feel when they're scared is fear, right? The 2 massive emotions that we all have as humans is fear and greed. Fear is definitely a more powerful emotion. And I can't think of a time, thinking about the last 3 to 4 months, where fear hasn't been incredibly high. We're worried about what's happening with Russia and Ukraine. We're worried about China. We're worried about the stock market. We're worried about inflation, gas prices. And unfortunately, over the summer months, we even had to worry about, are we safe in our own homes? Are our kids safe with some of the shootings that happen across the country? It's just a scary, scary world. As investors, we have to try to control those emotions. And what we don't want to do is succumb to emotions and abandon plan and sell at an inopportune time. It's interesting, and you've probably heard this, right? It's relatively simple. As investors, we all know, well, what are we supposed to do? Well, we're supposed to buy when things are low and sell when things are high. We're certainly not in a high point right now in the general markets. We're going through a bear market. We need to be very, very careful about letting our emotions take control and start making emotional decisions. And lastly, the third bullet point that we have on the slide that I just want to touch on is look for opportunities. Now, I've been doing this for 22 years, and I've been through 3 major recessions, this being the third. I don't know that I would call this a major recession, but a recession and a significant decline. And what has always held true, beyond my experience of 20 years and looking at 50, 60, 100 years, is every recession that we've always been through never lasted forever. The markets got through it, the economy improved, and as an investor, if you stayed with the plan, you were rewarded for staying with the plan. And we recovered and did well. So we need to keep that in mind as we are investors. And lastly, and I would really encourage you to reach out to, if you're having these emotions, if you're having concerns and you don't feel like they've been addressed, please reach out to us. I can't think of a time where what we do is more important for you. We don't have a crystal ball. We don't know exactly what's going to play out as we look through the back half of the year with the election and all these different things that are going on. But what we do and what we believe in is that we have a plan for each of our clients, for each of you, and we want to hear from you. And we would rather be hearing from you and having conversations about making changes or tweaks that might help you feel better than getting a panic phone call with somebody saying, "Hey, just get me out because I can't take it anymore." So please reach out to our team of investment advisors. Reach out to your advisor with us. We want to talk to you, and we're hoping that these educational forums that we do every month and items like this help answer questions and keep you informed on what we're looking at and what we're doing. So lastly, for the closing of the presentation today, we're getting into what the experts say. And so for many of you who have attended this event when we used to do them in person or have watched our forecast or halftime report, one of the things that we always have a little bit of fun with is pulling the experts. And if there's one thing about the experts it's always fun to look back on, is they're hardly ever right. But we still like to do it. We usually pull some experts in the beginning part of the year and like to keep tabs on how they did it the first half of the year. So let's see what they're saying about the year as we look at the next 4 months, the final 4 or 5 months of the year. So this is a quote from Bryant Swint. He's the acting deputy bureau chief. "The first half of the year was terrible, the worst in decades for stocks. Arguably the biggest single cause of the misery was the spike in oil prices. Russia's invasion of Ukraine accelerated a rise that was already building as the world emerged from the pandemic. To be sure, a lot of damage has already been done by high energy prices, but if they fall back soon, as history suggests they should, the second half of 2022 could be better than most people currently expected." That was a quote on July 1st of 2022. It is interesting. Today, August 15th, we have seen oil prices come down. Gasoline has gone into the mid fours in most parts of the country, low parts of the $4 per gallon in the eastern part of the country. Out here in Arizona, we're still in the high fours. But we've seen gas go down by about $1. And we are seeing some impacts to inflation and interest rates, and we're seeing some signs that's coming down. It'll be interesting to see if he's right. Seth Carpenter, the Global Chief Economist at Morgan Stanley, on July 1st said, "It's very difficult to resist the temptation to draw parallels with the 70s, but considering the following. In 1970, anyone 40 or older had already seen 3 episodes of inflation comparable to that of the present day. Today's 40-year-olds, which I am, have seen nothing comparable, and in fact are more familiar with deflationary trends than inflationary ones. In the 1970s, the thought must have been, here we go again, whereas today the question is, what is next?" And it's interesting because he's not wrong. I remember getting out of college, getting my first job in 2000 at RBC Dane Rauscher and buying my first home later that year. The interest rate of that mortgage on the first home in 2000 was just over 6%. It was 6.25%. I refinanced that house about 2 years later at 4%, and I've never had a mortgage over 4% ever since. For many of you, like my dad, my partner and mentor for a long time, my dad and my mom and dad bought their first home in 1973. They had to put 50% down. It was a variable interest rate mortgage at 13.5%. And my mom and dad said they felt lucky to be able to get the mortgage. So this isn't an inaccurate thought. We have a whole generation of people in my generation that have never experienced anything more than 4 or 5% interest rates with mortgages, and certainly haven't seen inflation like this for years. The question is, how will we behave and what happens next? We'll have to continue to watch this. David Rosenberg, president of Rosenberg Research and Associates, on May 13th said, "We certainly hope for a soft landing this time around, but in my 35 years of business, hope is rarely an effective investment strategy. The backdrop is one of in the peak, the liquidity and economic cycle, and what follows is the natural expunging of excess. Meme stocks, cryptocurrencies, speculative NASDAQ 100, even residential real estate, which is in a huge price bubble of its own, and then the rebirth." David's taken a bit of a contrarian approach to the previous two. Doesn't sound very positive to me. And again, very interesting because those meme stocks, when you look at what's happened in the markets this year, the stocks that have been punished the worst were some of those speculative meme stocks. If you were involved in cryptocurrencies or Bitcoin or really any of them, there's been a lot of pain, more pain in those areas than the general markets. And we're glad we haven't toyed with those areas much. The Economist, June 30th, 2022. Most important, the opportunity for innovation remains vast. The potential market for technology products has expanded hugely beyond the base station of business and consumers computing to affect all parts of the business world, from biotech to supply chain monitoring. What emerges from the chaos will be a leaner and more efficient industry, and one that will remain a powerful source. Sounds to me like they're thinking that the economic changes will be able to help the economy power through this, and that we'll see the market improve. We don't really know. And again, it's interesting as we pull these economists, because so often they're wrong. As we do this event twice a year, we like to look back and see what some of the predictions were. And very infrequently do you have an analyst that's right consistently. Everybody's speculating. Our belief is, in what we're going to continue to focus on, having and maintaining a diversified portfolio is incredibly important. We do believe that we've seen a significant decline, and when we look historically at what most recessions look like, some of the lows that were set in the early part of the summer look to be consistent with those bottoming processes that have occurred in other recessions. Doesn't mean that we're done going through this, and we could certainly see the market reach lower levels than that. But our belief is it's time to start to look for opportunities selectively and carefully. The plan that we've created with each of you is incredibly important and should guide us and lead us as we continue through this path. With that, I want to say thank you. I appreciate your attendance on today's Halftime Report 2022. I'm incredibly proud of our team of advisors and our professionals and our support team. And I want to say a special thank you to all of them for what they do tirelessly day in and day out for you and for our organization. I'm proud to serve you. I would be remiss to say, if you have people that you care about, friends or family, that you think could benefit from what we do, feel free to pass our contact information. We're happy to do an analysis of their investments and give them a second opinion. This is an important time, again, to be connected to your advisor. As I mentioned before, if you have concerns that you feel like have been that you'd like to discuss, please reach out to us. We want to hear from you. I wish you and your families a safe and healthy rest of your summer and a happy end to your 2022. We look forward to seeing you soon. Thank you very much and have a great day. Goodbye now.